Hey everybody, October, I'm doing the full education class on annuities, but I came across this article that essentially said, how do you approach talking about the annuities and ever recommending an annuity? And I still can't get over this part of the industry. And so I wanted to have a frank conversation. Why do we have to tiptoe around the annuity word? And I think I've kind of broken it down into understandable bite-sized chunks for everybody here. So if you have a stigma about annuities, well, here, this might help. So let's start with why the stigma is out there. Okay, why does it have a bad name? So the first thing I want to bring up is what I call the machine. From 10,000 feet, what I discovered, and as I got into this industry a good 15, 20 years ago, almost 20 years ago, um, I realized that we were set up in a way, we being the machine, the big box shops that run this entire industry and tell the SEC what to do. Those machines that we're talking about, right? And I realized that bonds are more profitable to the machine than, say, recommending an annuity, whether it's an individual bond or a bond fund. There was an entire industry built around that bond world, the debt that makes our economy run. Okay. Well, the funny thing is, you buy an annuity and they're buying a bunch of bonds anyway. So it doesn't really make that much of a difference behind the scenes, whether you're buying an annuity or you're buying bonds in your portfolio when it comes to economics. But if I'm a business and I'm running my business and I can make more money off my clients using bonds, there is where the real reason comes in. So the big machine, you're either going to own stocks or bonds, and they built their business model around that. They profit on that world significantly. Okay. More than maybe just the 1% management fee that's typical out there. CDs are also more accessible. So an alternative to a bond is, say, a CD, because at least you used to walk into your bank more often than not, certainly more often than you walk into your insurance company. And so banks were able to sell CDs. Now they even sell indexed link CDs and real fancy stuff out there. But the reality is they had direct access to you. So you've got the stockbrokers of the world saying no to annuities. We want you in bonds. And you've got the banking world saying you got to use my CDs. And then when we look at annuities from an income perspective, we had pensions, which the funny thing is the vast majority of private companies that ran pension programs, all they did was take a lump sum of money when you retire and go to the insurance companies and buy an annuity. That's all they were doing with the money. So in decades past, we haven't really had a huge need for annuities. Bonds did fine as interest rates were ticking down, ticking down, ticking down. And if you wanted an alternative to that, you went to the CD world because it was in your face. Okay, so there's the machine. That's behind the scenes, 10,000 feet. That's how it evolved into what it is today. Then the other side of this, okay, the sales machine. The sales machine is a big part of this. And the first part is you look at anything in the insurance industry, including home and auto insurance, life insurance, any insurance you can think of. Guess what? There's commissions. The entire insurance industry is rigged to be a sales machine. Now, look, commissions are unavoidable in a lot of circumstances. Again, think about home and auto. The regulators say that you have to have auto insurance if you're going to drive a car. So the reality is we can't avoid commissions in the regular world, but you also can't exclude an entire investing category just because you're worried about commissions. I got news for you. There are a ton of commissions in the securities world, the bond world, the stock world. The mutual funds are where we find a large amount of commissions, and a lot of bond transactions involve commissions as well. So I want you to understand the huge difference. In the securities world, the commissions come from your dollars, whereas the insurance world, the commission does not come from your dollars. If you put money into an annuity, the commission does not get pulled from that pool of money. It's built into the product, just like it is built into a CD. Believe it or not, whether you like to hear it or not, the banking person that wrote up that CD most likely got a commission. And it did not come from your dollars, because banks do the exact same thing that insurance companies do. So unfortunately, I agree, this is a stigma and it's a self-fulfilling prophecy. We have dinner seminars thanks to these commissions. We have people that are not advisors that sell these things to make a buck, whether you need it or not. They can misrepresent things. They can talk about things like they know what they're talking about, but quite often don't have any clue what they're talking about. I've seen all sides of that spectrum, and I don't like that part of it at all. That's why I've always said, if you're going to have an annuity sold to you, have it come with a plan in writing. How does it fit into your situation? How does it fit into your portfolio? I have no problem with annuities, but the reality is because there's too many salesmen out there that don't care about the bigger picture in your situation, just simply require a plan around it. Why does this work for me? How does it fit into my situation? And you get some form of plan in writing, then you actually have somebody that's a little more than a salesperson, somebody that's actually looking at your situation and saying, hey, let's go find what works for you. That's a huge difference. I have a product, everybody should buy it, or you have needs, let's figure out how to meet those needs. That's two different approaches, and you need to pay attention to that. But the other side of this is salesmanship and marketing can exploit all this as well. There's a very well-known company out there. You Google the word annuity, they're the first ones on there saying, I hate annuities and you should too. Well, that's just marketing, purely marketing. I've answered the phone and asked questions to those advisors, and they're not advisors. They're just simply salespeople on the phone. They're a marketing machine, and they have no clue what an annuity even is. They don't even know what they're saying. They have a canned spiel. Oh, they have too many fees. Oh, they have this. Oh, they have that. Oh, they feed into all the misinformation, which is the point of all this. You have the machine fighting against it. You have the sales situation fighting against it. And it creates a tremendous amount of misinformation and confusion. And the crazy thing, the invention of AI, and now anytime you Google something, the top, at least on mine, shows what AI's analysis is actually making things a little better and easier when it comes to understanding what annuities are and the stigma. And so I actually put in there, what's wrong with annuities? What's the misunderstanding and misinformation and confusion? And I came up with a whole bunch of great explanations of what's going on out there. I thought it was kind of neat. I keep getting surprised by AI, and I've found some inaccuracies, but I've been very surprised by the accuracies, because you Google this, and if you just look at the Google results of it, you're going to get sales spiels on both sides saying they're terrible, saying they're great. You don't get actual information, whereas AI comes up with actual information, which I think is really healthy and good for us to understand. So, misinformation number one: annuities are too expensive and have hidden fees. Well, I gotta be honest, it's just not true. It really isn't. And I know oh no, well, that's the way it is. No, it's not. Annuities, some of them have high fees and commissions, making poor investments. Well, that's a myth. And AI wrote this, not me. AI came up with it when I said, what's the misinformation and confusion about annuities? The reality is fees vary significantly by type of annuity. That's 100% correct. You can look at my videos from 2, 3, 4 years ago, and you're going to see the same thing on there. Annuities in the fixed world, the most popular one over the last few years, trillions, I mean, crazy amounts of money have migrated towards these fixed annuities called MIGAs, multi-year guarantee annuities. They don't have fees. They often have no annual fees. The commissions do not come from your dollars, and that's what it says down here. It's important to understand the commissions in the insurance world. The commissions are built into the profitability of it. So think about it like this. They're going to take your money and go and invest it. In an MIGA's case, the simplest case, they're going to pay you X amount of interest. Let's say it's 6% interest. Well, that's because the way they're going to invest it is going to have about a 8% investable profit to them, because they can invest in ways we can't, because they have billions of dollars. Okay. They can buy blocks of bonds that we can't get access to because they can buy the whole block. There are things they can do that we can't do. So the reality is they built it in. They know the profit of what they're going to end up with, and they can pay some of that out in a commission to the advisor. And this can be a win-win situation, because the reality is the advisor makes their fee and you have no fees. Well, you go buy a bond and you're going to have a management fee typically, or a commission involved there. You buy a CD, you're going to get paid less interest. You'll find out real quick here, but the person that sold it to you certainly got their commission, right? So fixed annuities, typically you won't see any fees in those. That's not too good to be true. It's very normal. Just like you don't see the fees in CDs. They're literally CDs from insurance companies. Variable and indexed annuities. Well, sometimes they have fees. Now, I haven't seen a variable annuity without a fee, because think about it like this. You're investing your money in mutual funds. You get to choose the mutual funds and put the money in the mutual funds. The only reason the insurance company is there is because the annuity wrapper is a tax deferred vehicle. So for the insurance company to put the product out there, they don't get to go invest that money. Your money's in the mutual funds. So they got to charge a fee to have a reason to even put the annuity out there. And then you get tax deferral, which I argue is usually not a great thing. And it's typically not used properly. Nobody likes paying taxes, but I don't like changing good taxation into bad taxation. So I'd be careful about using it just for the tax deferral side of it. So variables typically will come with at least a small fee, but then you add bells and whistles and it starts becoming more and more fees. And then watch out for those mutual fund fees as well. Whereas indexed annuities, the vast majority of indexed annuities have no fees, just like the MIGAs. They're built just like that, except with flexible ways to earn interest. Okay. Now, you add bells and whistles, and all of a sudden you can add fees, but those are typically choices in the indexed annuity world. Now, commissions, again, in the insurance world, they don't come from you. Okay. So not deducted directly from your premium. Okay, I didn't come up with this, AI did. And that is the truth. That is what we see out there. It varies significantly by type of annuity. Can't overgeneralize these things. Your money is locked up and illiquid. So the myth is, once you buy an annuity, you can't access your money for years. That's obnoxiously wrong. As a matter of fact, it's one of the advantages they have. You buy a CD, you can't touch the money until the term's over. So that forces you into shorter terms. The reasons MIGAs, or one of the reasons MIGAs became so popular, multi-year guarantee annuities, the CDs from insurance companies became so popular because they were paying a little more interest than the CD world, and you had access to the money along the way. So you could lock higher interest rates in for a longer period of time. And when interest rates jumped up the way they did, it is a smart thing to do to lock in the higher interest rates for as long as you can. And you want to have access to that money. Well, that's the big part of this. A lot of these are going to give you 10% access annually. That means every anniversary it refreshes your access and you have a fresh new access to more money. So if you manage the liquidity, in a lot of cases, this ends up being a much better way than CDs, certainly, and arguably bonds and bond mutual funds, because you're exposed to the market when you try to sell those bonds and bond mutual funds to create the liquidity that you may need. right? And so if interest rates rise, the value of those bonds goes down and you end up losing money when you go to pull that. Okay. And a lot of them offer waivers for hardships like nursing home or terminal illness as well, meaning you can have access to all the money if you're in a long-term care facility. Pretty universal across the board. So people are pleasantly surprised once they understand this type of investment. So here's the myth. If you die prematurely, the insurance company keeps all the remaining money. Absolutely not. The vast majority of annuities, 100% of the money that's left over in the account goes straight to your heirs with no penalties. The vast majority of these. Now, income annuities are going to be a little different scenario. Some of them are withdrawal benefits, meaning whatever's left over, if you didn't withdraw your last dollar, it goes to your heirs. Whereas some of them are paying a payment for the rest of your life and have no cash value. So that would not go to your heirs. Kind of like a pension. Think about Social Security. Social Security was built off the annuity world. Annuities came first. Here's another myth. Annuities are exclusively for those who have already retired and need income. Look, annuities come in all different forms and fashions. An income annuity, as I'll show you in a second, is one type of annuity. So there's lots of different types of annuities. And the most popular version of annuities is really they're replacing CDs and bonds and bond funds. Okay, it's a diversification for your safe, stable portfolio. And so a lot of people like that, but younger people, especially in the 50-year-old range, need to be looking at the pensions. If you don't have a company pension and you're going to rely just on Social Security for your guaranteed income in retirement, you might want to consider the deferred income annuity. Right? These are going to become more and more popular because it's a newer thing that we don't have as many company pensions out there. This has been slowly going away. And so there's a whole generation coming that doesn't even know what a pension is. Only public employees, if you work for the government somehow, that's the only people that get those things. Let's see. Another myth that came up with it being the AI machine out there. Annuities are too conservative and offer low returns than market investment. In most cases, you're absolutely correct. You're looking at the vast majority of this is as a safe, stable investment. You can't compare Apple. That's like saying I'm going to compare a CD to a stock portfolio. They're two completely different animals. I'm going to compare my bond portfolio to my stock portfolio. Well, the stocks have won, especially for the last 15 years. The stocks have been fantastic. So don't let anybody make you believe that you're going to get all the stock market growth and less risk or no risk. Right? That's not what this is about. Fixed annuities, the MIGAs that are out there, those are specifically designed to grow at a fixed interest rate, just like a CD. Whereas indexed interest rates, again, the indexed is without risk of market loss, right? So sometimes when the market goes up, you're going to earn some of that, but not all of it. Don't think that you're going to get all of it. I'll show an example of that coming up. Okay, so you're trading off the growth potential of the stock portfolio for less volatility and no market-based risk in the fixed and fixed indexed annuity world. Whereas the variable annuity, you get to invest directly in the stock market, but you have the extra layer of fees. So I'm going to say you're always going to underachieve the market because of those fees. You have an added layer of fees, an added person with their hand in your portfolio. Here's another one they came up with. Let's see. All annuities are essentially the same. Look, there are plenty of sales spiels out there saying they've got the golden grail of investing. This is the greatest thing you should ever put your money into. I've seen sales spiels on variable annuities, these wonderful, income annuities, all this stuff. I've seen it all. And they make everybody think that everybody has to put their money in this one investment. That's not true. The reality is there are many different types of investments in the annuity world. The fixed annuities, again, the most popular lately with these higher interest rates. Lock them in for a longer period of time and still have access access to your money. Immediate annuities pay guaranteed income starting right away. Deferred income annuities, those are going to pay income at a future date. So you start it growing now, so it'll pay you that pension payment. Variable annuities, your money's going directly in the stock market. Indexed annuities are just like the fixed annuities, except to give you more ways to earn interest than just the fixed rate. So there's lots of different types of annuities out there, and it starts with your needs and how does it, how to place these in your portfolio. And I'll show you the easiest way to do that. Annuities are a one-size-fits-all product. All annuities are essentially the same. We already did that. Oh, did I go the wrong way? Yep, I got it. Okay, so I'm going to tell you it's real easy. Simplify it. All that gobbledygook we just went through, oh, I don't understand this stuff. Look, that's a common misconception. They're too complex. Well, I got news for you. They're not. And if you don't think that an ETF or a mutual fund is complex, you haven't looked into it to understand how it works and what it's actually invested in. If you don't think a bond is complex, then you've never actually read the contract. Yes, that's right. Every bond issue has a contract. It says when they can call them due. It says what they're all the things that they can do. Okay. The reality is the investing world is complex, but it doesn't need to be. I've always known what stocks are. Well, have you ever looked into all the companies in that mutual fund that you own and what they do? And do you know what a zombie company is? A company that owes more debt and doesn't even have the income to pay the bills on that debt. There's so many levels of complexities that are out there in the investing world. So I'm going to simplify this real quick. The annuity world, I want you to look at it like this. These are planned investments. These are investments that you need to know what their place is in your portfolio. And I broke it down real simple. Guaranteed income. Okay. When we look at guaranteed income, I look at it like this from a financial planner standpoint. You need enough income to pay your base living expenses in retirement. Okay. We need to be reasonable about this. You got to keep the shelter over your head. We need to create a survivable retirement. Okay. And if you have no heirs, then fine. More income can be better. Some people get sold in these dinner seminars how wonderful these guaranteed income annuities, and they get so many guaranteed income annuities and it provides income they never, ever, ever needed. And it's just a dead asset in their portfolio. No, these income annuities can be fantastic, especially for people that need more income to pay base living expenses. It's almost universal. When I see somebody that has less guaranteed income than their base living expenses, no matter how much savings they have, they are still insecure about money and insecure about retirement. If you have enough income to pay your base living expenses, it shows up in your bank account every single month. It alleviates a lot of financial stress. And some people don't even realize it until they see it in black and white. They see their situation, they do a budget, they look at their income, they look at their resources, and they realize it, and that takes the stress away. It is so important that you have that realization as you're in retirement. And the annuity world is well known to have guaranteed income. It is the only place that you can go to get guaranteed income. A rental property is not guaranteed income. A CD, the interest you're getting is not guaranteed because that CD expires. Anybody that's ever been a landlord knows that rent is not guaranteed. The only place you can add guaranteed income is the annuity world, right? So then the other side of this is the safe, stable investing world, right? Alternatives to bonds. And if you haven't realized bonds, you can't be your only safe, stable investment in your portfolio, then you're not paying attention and you don't understand. And if your advisor hasn't figured that out, they don't care. They just simply don't care. It's not possible. This was so obvious that the interest rates were sitting around so low for so long that everybody needed to diversify out of that bond portfolio. And the machine's answer was, well, let's do a bigger stock allocation, which, hey, guess what? The stock market went straight up for 15 years. It happened to work out. But don't get a false sense of security in that. Go back and look at what 2000 to 2010 looked like, because that's when I was getting in this industry and learning this world and seeing what was happening to people and seeing what this advisory world, a quote unquote advisory world, what their answers were. And it was ridiculous, right? So the safe, stable investment world in the annuity world, well, it's an alternative to CDs and bonds and bond funds, okay, for those that are risk adverse or need to withdraw regularly. I do a lot of education on who needs safe investments. Not everybody needs safe, stable investments. Some people need it because of emotional reasons. They just don't like the ups and downs of the stock market. And some people need it for practical reasons because they need to have a stabilizer for their portfolio to be more efficient in their withdrawal years. That's really what this is about. So the safe, stable side of this, look, MYGAs became super popular for the last 2-3 years at these higher interest rates, and there's obvious reasons why. They're blowing away bonds and CDs. That's just the bottom line. You can guarantee 10 years at 6% right now. You can guarantee 7 years at 6.6%. 5 years, 6.35, 3 years at 5.75. So when we look at the MYGA world, think of these as CDs from insurance companies. Okay, that's important to understand, but they're going to come with some significant differences that everybody needs to understand. Now, the difference between a MYGA and a fixed indexed annuity, okay? The fixed indexed annuity simply gives you more than one way to earn interest. And I had to consolidate this a little bit. There's, I think, 2 more ways to earn interest in here as well, but I just couldn't fit them on here. So the cool thing about this, and this has changed over the last, say, 4 or 5 years, super important. One of the stigmas about fixed indexed annuities was they could change how you were earning interest after you get in there. They reserved the right to adjust how you were earning interest every year. Well, that wasn't fair. You start at 80% participation rate. That's right, they don't all have caps. I'm not necessarily a big fan of caps, but they give you what's called a participation rate. If the stock market was up 10%, you get 80% of that. That means you get paid 8%, right? That's how a participation rate works. This company is guaranteeing the interest rates for all years of the contract, meaning if you can't pull 100% of your money out, they can't change the interest rates they offered up front. So that was a very good change, and why these are becoming so much more popular, because we don't have to worry about them changing the interest rate. So they give you different stock indexes, and they give you a fixed interest rate. The 1-year fixed interest rate is 3.5. And I say it's 1 year because you choose how you're going to earn interest each year. Okay, so it's not a guaranteed 10-year interest rate of 6%. It's a guarantee for 1 year because you can then change how you're earning interest year to year. And each of these stock indices, and again, there were 2 other strategies, and one of them was a cap rate. That's why it says they're guaranteeing the cap rate as well. They give you a 1-year option and a 2-year option. So instead of earning interest every year, you could choose to wait and earn interest every 2 years, and they'll pay you more of that stock index. And in this case, they'll pay you more than 100% of it, because they're not investing this money in that stock index. They're simply buying options. They buy the option to buy that index. So if it rockets, they already bought the option to buy that index way down here. That's how they protect themselves, right? So if the stock market rockets and they got to pay you over 100% of that stock index, they've protected themselves by buying the options. Okay, that's how these things work. These fixed indexed annuities are actually kind of neat when you figure out how they're doing it, right? And that's why, you know, the banks have come up with these structured notes and things like that. It's all based on this. These fixed indexed annuities, they made the banks create these structured note world, and they made the banks create the index CDs. They're all based on the same exact principles that these fixed indexed annuities are based on. So Why have these become so popular? Well, tax-deferred compounding or simple interest, okay? Some of these are simple interest. Vast majority of these are compound annually on the fixed index side. The fixed rate here is compound daily. And when these MYGAs are compound, they're compound daily mostly. Let's see, 0 to 10% penalty-free withdrawal access each year. Okay, so understand, some of these MYGAs will give you zero access. Some of them will give you access to all the interest, and some of them give you the typical 10% access annually. So that's something to make sure you know. The vast majority of fixed index, it goes straight to the 10% access annually. So that's usually the default. Anywhere from 3 to 10-year surrender schedules. I've actually seen somebody put out a 30-year MYGA. I don't think that's a good idea, but I've seen them longer than 10 years. But typically you'll see anywhere from 3 to 10 years. Same on the fixed index, more 5, 7, and 10 year that we see on fixed indexed annuities. And then full remaining value passes to heirs without penalty. These are cash value investments, no different than CDs, no different than a bond portfolio. These are cash value investments. You pass away, surrender charges are waived, your heirs get 100% of this money. No fees to you and no market risk on either of these. You're getting paid interest on how the market does. If the market goes down, you get paid nothing. By regulation, fixed indexed annuities are not allowed to reduce your value based on stock market performance. Fixed indexed annuities have regulators up there, you know what's, saying, whoa, 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 we cannot have any market-based risk in this category. Otherwise, they get moved to the SEC, and they're called variable annuities, right? There's a new version of them out there, market-linked, type annuities that do have risk, but these fixed indexed ones, they do not have risk, right? Very important, very important. So those are the popular ones. So you either need guaranteed income, and there's a plethora of choices out there on that, or you need safe, stable investments. That's what you're looking at for the most part in the annuity world. Hopefully this simplifies it. Hopefully it demystifies why there's this weird stigma out there. Not everybody needs an annuity. Certainly, that's plenty of people out there have no need for an annuity. But your safe, stable portfolio, that allocation to the traditional bond, these are great diversifiers. Both these choices are great diversifiers from the traditional bond portfolio. And from a planning perspective, I want to make sure people are paying attention to their guaranteed income and paying attention to their budgets in retirement. You need to have enough base income to make you comfortable in retirement. And so being proactive, sometimes the annuity world, the deferred income annuities can work out fantastic. And I always tell people the 50s or when you want to start looking at that, maybe early 60s, that's the good window to look at that. Right now, just because of where interest rates are at, the immediate annuities are not great. They're not wonderful. You just have to live a really long time for them to be profitable. So I hope that helps. Again, October, I think it's October's class of the month on fpfeaz.org. We do a full hour going through all the different types of annuities, what they are, what they do, all that kind of stuff. Really a more in-depth version of this little video here. So jump on there, fpfeaz.org, and sign up for those classes. I do a different topic every single month. Yourinvestmentcounselor.com if you want to meet with me for any reason and discuss any of this. I'm always happy to do meet and greets. I love meeting people from all over the world. And certainly give us a call. Like, share, subscribe, do all those wonderful things. I'm sure I'll get plenty of comments about how great or terrible annuities are. I see it all the time. They seem to be polarizing, and I don't get it. And a good advisor, they're all just tools. You have to have your blinders on. You can't listen to all this noise because that's all it really is. It's misunderstandings and misconceptions. Some people have had bad experiences with all different types of investments out there. It happens all the time. It's not just annuities. All right, everybody, have a great one. I'll see you next week. Thanks again.